So the past couple of months have been a roller coaster for the stock market. December clocked in with historic all-time lows. What does that mean for you and your wallet? Our retirement expert, Kyle Odell, is here to talk about that. Thank you for coming in.
Thanks for having me.
Appreciate it. So extreme highs, extreme lows. What's going on with that?
You know, the market has been all over the place, and there are a couple primary things that move the market: math and emotion. So for the last several years, the math has actually looked really good. The market's moved along and done well, but the math's not looking quite as well as it has in the past, and it doesn't mean that it's bad right now. It's just looking okay. And when we look at, there are a number of things. So we have China's economy that's really not looking well at all. We have the trade war with China. Europe's economy is looking poor. And you know, when we start adding all that up, that causes pressure on the market. And then we have a leader like Apple, who a week ago stepped up and said, you know what, hey, our fourth quarter sales, they're just not what we forecasted, what we projected. And so when you have a leader step up and say, look, we didn't perform as well as we thought, that caused a lot of fear. That spooked the market. And so what we're seeing with that is a global slowdown overall. And so that's causing a lot of fear in the market. So when you have the math isn't looking as well, and then you add on top of that the fear part, which is just gasoline on top of the fire, that causes the market to really start fluctuating. Yeah,
so I guess it's probably not time to freak out yet, but most of the time people say, well, if you have a balanced portfolio, you'll probably be okay. What does that mean exactly?
So a balanced portfolio a lot of times is meant that as someone heads into retirement, that you should have about 50% of your money in stocks and about 50% of your money in bonds. That's been the rule of thumb over the years. To be quite honest, I'm not a big fan of that. So with that, and the reason is if we look at bonds, most people think that bonds, we have a misconception. They think that bonds are safe.
Right.
If we go back and look at 2008, a lot of bond portfolios lost money. In 2018, a lot of bond portfolios lost money. So a purpose of a bond is not safety. The purpose of a bond is to produce income, a yield. Now, bonds are not producing much yield right now. So if I were an investor, I don't know that I would take that approach. I would look for bond alternatives to produce income out there.
That's interesting. Yeah. What are some of the alternatives, do you think? You
know, there's a gentleman that was actually the founder of Morningstar, Roger Ibbotson. He's one of the most respected economists out there. He's a professor at Yale. He wrote what's called a white paper, which is a factual paper on bond alternatives last year, and talking about how you can use one of them that's out there is an annuity. Now, most people use an annuity to produce income. You can also use an annuity where you strip out the features and the fees that produce income, and you just use it as a safe place to park cash to produce income where you can just make withdrawals out of it. There are a lot of alternatives out there, but that's certainly one that has a better producing yield than a bond right now.
That's pretty interesting. How can people kind of take charge and be more empowered to make decisions over their market?
I'm going to give you an easy answer, but it's not easily done. So, and the problem is that investors operate on the market and we make reactions and so forth based on fear. So when we look at it, if we go back 3 weeks ago, December 19th. That day, $56 billion was sold in mutual funds that day by individual investors. Okay, that was the largest selling day since 2008. And the market was already down. So investors were making an emotional decision. Market's already down. I'd get my money out, and they'd already lost a bunch. That was a poor decision that day by a lot of people. So one is not making decisions based on emotion, but making on math. The problem is most of us just don't have the time to do that, right? And so that's where I would say, look, find an advisor out there that handles your money the way that you would want your money handled. Find an advisor that, where your just how you look at money, you align together well based on, and I would ask a lot of questions. What do you do when the market's up? How do you react, Mr. Money Manager or Mrs. Money Manager? What do you do when the market's down? How did you do in 2008? Ask a lot of questions to dig in. Most people have a misconception in that, hey, when the market starts dropping and so forth, that my money manager is going to move me out of the market or do something to protect me, and they usually don't. And so, and not that that's a bad decision, but you need to find someone where you align with them on how you want your money managed.
You trust them.
Yes.
All right, all good advice. Kyle Odell, thank you very much.